Hello.
We are
Welcome
live.
to our first stream. We're live.
Oh man, Dan, what a panic moment, man. X kind of threw us under the bus for 12 minutes.
It rugged. Yeah, we were a little worried about starting the stream because most of the audience is on X. We appreciate the YouTube audience standing by, and we were thinking of join. Oh, who's running the audio back?
What's that?
Where's that sound coming from? Is that me? No, that was me. I had because I had YouTube open to check who was going. Hey guys, we are live. We are here. I'm gonna bring out these. I'm gonna hide those guys. So we're here, and we're gonna have our first workshop on how to trade crypto options. And none of this is financial advice. This is just educational material that will help you on your trading journey. Joining me is Steamboat.
Hi guys. So you would know us mostly from our weekly live streams, but this time we're going to change things up a little bit. It's going to be more educational. It's going to be focused on trying to help you understand how to trade crypto options. So put and calls, but there's a lot more to that. So we're going to dig a little bit deeper and just hoping that you guys can pick up some useful tips and you can start trading more effectively with your options.
Now, some of this might be a little technical, so there will be questions. Just feel free to drop them in the chat or drop them between segments because we're going to have these guys answer your questions. Welcome, Fred and AK.
Hello, guys.
Feel free to introduce yourself, AK, and then Fred.
AK's mic.
Your mic.
Okay, are you guys able to hear me?
There we go.
Yes.
All
There we
right,
go.
awesome. All right, thank you so much, guys, for inviting us, Kryptonite Academy. So my name is Ekiel. I represent the Kryptonite Academy side of the community, and we are the established training academy in Singapore. We're the longest running and the largest community in Singapore itself. And in this session itself, Paradex was wanting to do an educational education session in a way. So they reach out to us to support them and to kind of like give them some pointers on what we can do to help each other out. So I thought, why not? Let's do it. Let's set it up. And we have Fred, who is from Paradex, who will be sharing for more tonight. So I'll hand things over to Fred.
Thanks.
Do a quick introduction for yourself.
Thank you. So yeah, first of all, hello everyone. I hope a lot of guys are tuning in here. I think already Dan kind of made a good intro already. This is of course not financial advice, and options they can be a pretty complex topic. You can go into depth very, very much here. You can go down the rabbit hole, but we're trying to keep things to some extent educational, informative, but also very practical. So there will also be a lot of sections where I will just share my screen. And we can, do some sort of like live trades on options, and we can actually walk step by step through on how you can trade them, how you can hedge them, what kind of strategies you can do. And I hope it will not be too complex, but it will be informative enough for you to kind of do your first steps and use options, because options are, frankly speaking, a great tool for risk management, but also to just express your view on the market in a more granular way than you can maybe with perps only.
That was a great introduction. Now, I gotta say, since we had that outage on X, I think they are still trying to get their live streaming setup back online. So we are not live on X. But we're here. We got everyone here. This is going to be recorded, and I can publish this later onto X as a live stream once that goes live. So we'll do a little cheating live stream behind the scenes. So
I think we're live on X now.
Did it go live?
Just.
Oh, good. I just reset the connection. Perfect. All right. Hold on. Going back into it. Welcome. We're back.
Right. Okay.
We're resetting. So today we are going to learn how to trade crypto options, but this isn't financial advice. This is an educational workshop brought to you by Paradex. Joining me is Steamboat.
Hey guys, so I'm not the one presenting here, so don't worry. We have someone who understands options a little bit better, and it's going to be very educational, very technical. So feel free to ask questions. We're going to be observing the chat. So if at any point in time there's something else you want to ask, want to explore, or you want to just go deeper into the concepts that are being shared, feel free to ask questions, and we will make sure that our trainer addresses it.
Yes, and speaking of our teachers for this, we have AK and Fred. AK, can you please give us an introduction?
All right. Oh, is it me right now? All right,
It is you.
it just went for a short, kind of like a little bit. But yeah, thanks for inviting us from Kryptonite Academy. So my name is Akyong, or AK, as generally more of our friends call me. So I represent Kryptonite Academy. We are the longest running and the largest crypto community in Singapore itself. We are established since 2017, and right now we have trained more than 43,000 students on crypto trading and trading as well. So tonight we are very grateful to have Paradex set up this educational segment on crypto options. And I will hand things over to Freddie, who is part of the Paradex team, to share and lead this session on crypto options itself.
Thanks, AK, and thanks, everyone. Yeah, I mean, just a quick intro myself. I'm part of the Paradex team. I work there. I also happen to like to trade options quite a bit in crypto and TradFi. But like Dan already said, not financial advice here. Crypto options or options in general, you know, there's a big rabbit hole you can go down to go into a theory and really understand them. I'm not claiming I know it all, definitely not. There's like much better experts than me, but today we're just trying to not keep it too light, because I think a lot of you know like what is a put, what is a call, but we kind of want to keep this very practical. So I'll also share my screen in a couple of sections where we can walk through some of the trades, kind of show you how you can put them on, how you can express your view on the market, how you can manage an option trade as well. So I hope there's a lot of practical tips you get away from this. But yeah, like Dan and the other guys also said already, please feel free to chat very actively, ask questions, and we're trying to keep this very interactive in that sense as well.
Great intro. So yeah, as Freddie just said, we are going to answer your questions and we're going to walk you through this. So if you want to drop some GMs in the chat just so we know you're there, we'll keep this workshop going. So with that, let's dive in. Fred, what's the first thing we're going to learn here?
So, I mean, today we're definitely gonna, like I just said already, we're trying to talk through some actual option strategies that kind of like allow you to express a certain view you might have on the market, right? Because there isn't just the view of like we're going up or we're going down, right? There's also the question of how much are we going up, how much are we going down, with what kind of speed. Are we going to chop a little bit around? Are we going to break some ranges? So we're going to talk about some strategies you can put on with options to kind of trade these opinions that you might have on the market. We're also going to talk a little bit in general about risk management, how to survive basically, right? I mean, how not to get liquidated, how not to kind of blow through your whole account. And yeah, I think that's kind of the overall part, or the overall topic of this workshop. And I think we're kind of starting off with a concept that might seem a bit complicated, but it is actually quite simple. And I think most of you will also understand why it is that way. But I basically have a question to everyone who's on the stream right now. So imagine you can toss a coin, yeah? And every time you need to invest 50% of your account balance, but there's a 60% chance that you win and 40% chance that you lose. But you need to invest 50% of your capital all the time. So I would ask you guys, like, who would play that game?
Everyone, right?
I mean, also you guys, like, who would play it from you?
60% chance to win or to lose? Sorry.
To win. So you have a positive edge.
Yeah, 60% of the time it wins every time. That's what it makes sense, guys.
And I have to put 50% of my capital for each bet.
Yes.
Okay, got it. You guys heard it. We want to see some replies in the chat. Hello, Roman. Hello, Jobs. GN Clark. Kilo. Questis.
All right,
Well,
so yeah, let's start diving in.
Well,
sorry,
I just see. Oh, sorry to interrupt. I just see probably we're not getting much replies because at least for me, Twitter is down again or X is down again. So
oh no.
I think the live stream is also down. But
the show goes on.
okay, well, okay. So let's maybe start with the slides. You know, we have a couple of slides. There isn't too much on it. You know, but we can kind of like have them on and talk a little bit about it. So I maybe let me just kind of guess what most of you would have said, maybe what I would have said too. It's like you would probably say, yeah, sure, let's play that game, right? There's a positive edge. Maybe if I would ask the follow-up question, like how often would you play it? Maybe then people would start to think, right? If I need to put 50% of my capital in every time, how many times can I win? How many times do I lose? Well, 60-40, right? But overall, maybe there's a misconception that you would think, well, there's a positive edge, right? So I should just play that game, right? I mean, you could almost see it as trading, right? If you also trade with leverage and you're willing to kind of bet half of your account size each time, but you're more often right than you're wrong, right? That kind of feels like that's a good strategy that works. But here comes the crux, and maybe now we can switch to the first slide, and the kind of detail here is like geometric versus arithmetic returns, right? So on a arithmetic return, that's basically the green line, right? And you see, yes, there's positive edge in that game, right? So the average gain, if you could look for arithmetic growth, is positive. But geometric returns are basically the compounded returns. And that's where you actually see that the more often you play that game or the more often you trade that way, the more people actually end up losing more than their initial starting capital, right? It's only a very, very few amount of people that will earn a lot of money there. You know, you can almost see it as like, just a couple of guys will win like 10 times in a row, right? That's statistically very, very little, but they will make a lot of money, right? But the majority of people will actually end up losing more. And that is pretty much the explanation about this is just like that it's a true compounded return, because once you win, right, you get 50% extra, and then you lose 50%, you're actually down, right? Because losing 50% of your overall capital to recover from this, you need to win more than just once again, right? So that is basically a concept that, you know, I kind of want to get people into people's heads to think about, okay, maybe I should not bet my whole account size all the time, even though I know that I'm more often right than wrong, because you still end up taking sometimes big losses, and it takes more than just one win to recover from it, you know, to your initial account balance. So position sizing, that's basically the key here. Position sizing is very, very important.
Yeah, well said. I don't appreciate though that you took a picture of my portfolio there and it's all in red.
Well, not only you. I mean, we're all falling to that desire sometimes, you know, including me.
We got a comment from Nicholas. Fred the goat of perp options until he blew up the vault I made him do to put my money with him.
Nick,
Yeah, well, I mean, to be honest, that vault was going very well, you know, and sometimes you need to take profits when it's going very well. And I hate to say it, but I did. So even though it blew up at the end, for me, it was still a positive endeavor.
Now, real quick, I just want to touch on that because Paradex has vaults, it has options, and if we can get like a brief explainer of like how those work.
Sure. I mean, why not just share my screen quickly? I mean, I can just kind of showcase our vault section here, right? So you see on top, we actually have this nice vault section, and obviously we have the gigavolt, right, which was our protocol Volt that is basically liquidity provider for a lot of our coins and also the perp options. It also, takes in trading fees, liquidation penalties, is of course the counterparty for liquidation. So that's why, you have a very steady 22.6 APR right now. But then there's a couple of protocol, let's say user run Volts, right? So I already skipped. We have a couple of VTFs, Volt traded funds. You could actually see those as kind of leveraged ETFs. There's in TradFi these kind of products where you can go like 3x long on AI centers, or like 3x long on consumer goods or whatever. So we have a couple of these things as well. For example, you can go 3 times short on the majors, on meme coins, on altcoins. Those are obviously performing quite well right now because the market is dumping. But then we have basically here the user Volts. And user Volts are Volts that any user can basically start. You can just create one. It's a very easy step. I mean, I'm not going to go through it here, but you just put a name, quick description. You can actually limit how much money you want to allow to be put into it. There's a slider for profit share, so there might even be something in it for you if you're good at it. And you can set a lockup period for users to withdraw, basically. So you can also get a bit more certainty on the funds you have in there. I would also say, though, be a bit careful. Don't just invest in, like flashy numbers here, because obviously there are some guys like, that just start a Volt with $400. I mean, not to shame anyone with, not having much money, but 13 days old, that might not be something you just want to put your capital in immediately. But there's a couple of Volts here that are, running for quite a long time. A lot of them are going to zero. A lot of them are doing relatively well.
Right. I just want to jump in here, just for the people who haven't tried out these vaults. When you invest into these vaults, pretty much you're investing in whatever they're trading.
Correct. It's kind of like, a lot of people maybe know that concept of like copy trading, right? This is like an automated copy trading, or if you want to go like the TradFi route, that's just basically an investment fund, right? Like you're putting your capital into that fund, and that Volt owner will just trade with that capital. Simple as that. And you will participate in basically their performance. So, for example, with the Gigavolt, you see the token price here, right? So that's basically, if you invest in the Volt here, you basically buy shares of that Volt, right, for like $1.02, and now that share, each token would be worth $1.31 or something, right? So, and you buy a fixed amount of tokens when you invest. So, like I said, it works exactly kind of like an investment fund.
Well said.
Yeah, that's the short form of it. And like I said, everybody can run a Volt. It's not restricted to anyone.
Okay, so that explains our vaults at Paradex, and I think it's a good time to start jumping into some options.
Sure. Maybe bring up the presentation again, so
yes.
we can kind of just talk through the topic here. Yeah, so options, very high level. I think you can move to the next slide, or can I do that? Actually, I can't see how. Yeah, so I don't really want to talk too much about the Greeks. You can kind of look them up. There's like a lot of explanations about it, but just to kind of cover the very basics, there's obviously 4 Greeks. They are kind of deriving from, or they're kind of part of the option value, right? The one we are focusing most today will be delta, because delta is also a good concept if you trade options together with perps. It basically just means your directional exposure, right? So everybody knows trading perps. If you're going long 1 ETH, your delta is 1. If you're going long 1.5 ETH, your delta is 1.5, right? Simple concept, right? Like ETH goes up $1, you earn $1.5, right? Because you have 1.5 ETH. For options, it is kind of the same way, but the delta is kind of dynamic, right? So options always change in that sense, because they're going further in the money or further out the money, or they have a time decay, which is actually expressed as Theta. And then the change of delta, because like I said, they're dynamic. If the market changes, the delta of an option will change, and the rate at which it changes is called gamma. And then Vega is basically the volatility part of an option, right? So options, sometimes you see their price, of course, in dollar terms, the premium, but you can also sometimes see like a little percentage below, and that percentage actually is the volatility, and that's kind of the expected change of the underlying over 1 year, right? So if it's like 40%, the option is priced as if the underlying could go up 40% or down 40% in 1 year. But like I said, we kind of still want to focus a bit on the delta aspect today, since the other ones are, a bit harder to explain. And I think if you are interested in that, you can, Google them. You will find good explanations about them. But yeah, let's maybe move on to the next slide, or if there's any questions already on it, let me know. Yeah, so this is actually, probably some option geeks will tell me like, oh, this is very wrong, what we're putting here. But there's like a kind of rule of thumb, and I think it helps you just understanding a bit the probability of profit, right? So if there's like an option with a 25 delta, you're basically, there is like an implied chance of 25% that this option is basically earning you positive P&L. So that is, like I said, in theory, it's not fully correct, but it's a good rule of thumb to kind of think about it like that. And you will also notice it, right? Like the out the money options, if they are far away from the strike price, they always have a lower delta, right? And the in the money options, they almost act like a perpetual future already, right? Because they are close to getting to 1. So yeah, that's kind of a good rule of thumb there to kind of think about delta, right? And like I said before as well, if you buy an option with a 0.5 delta, it's kind of the same as you buying a perpetual future of 0.5. Putting a little break here, hoping there's maybe some questions coming in here.
No questions yet, but I think your little tips here and there are going to be very helpful for people to understand like how the relationship between the numbers work. So keep going, Fred. Thanks for that.
Yeah, this is great. This would be like a great graphic. We just need bigger text. We just need bigger text on this thing.
True. I noticed as well. Yeah. Like I said, I mean, in theory, it's not fully correct what I'm saying here, but I kind of, like I said in the beginning, I wanted to put this, very practical and giving you some ideas, and seeing delta as a percentage of chance for profit is kind of a good mental bridge, at least.
Yeah, well said. I don't have any questions. I'm just here learning and just trying to figure it out too. I'm keeping up though.
Cool. All right, let's move quickly on. But for the next slide, we could actually also just look at that, straight at the screen on Paradex itself. But actually, I think we can just walk quickly through it here. But this is just basically an option chain, right? You see, these are actually, I think, calls right now that we're looking at, and you see they have different strike prices, right? I think I'm not going to go into detail about what that means. Obviously, if it's a dated option, it would mean you have the right to buy it at 102K, for example, right? And if we're above, then it's usually a good deal to exercise on it. For the perpetual options that we have on Paradex, they actually don't expire. They don't exercise, so they will constantly keep being on, and you're paying for it as funding. I already mentioned before Theta. Theta is kind of like the time decay that your option loses value over time the closer it gets to expiry. On Paradex with the perpetual options, you pay basically a funding rate, and that basically represents this. But that also means that your option value, if nothing changes, also doesn't change, but you instead pay the funding basically. But yeah, like I said, that's just basically the option chain. Is pretty boring. But let's kind of maybe move on to the next one already, because I think now it gets a little bit more interesting how to think about options, because options give you if you can go to the next slide, because I think that's that. Yeah, cool, thanks. So like I said before, options, they sometimes give you a more precise way, it's kind of like a toolkit to express a view you have on the market. And I think one very famous combination is a straddle. Straddle is actually pretty simple. You're buying a call and you're buying a put at the same strike price, right? And what that means is you're basically betting on volatility going up, right? Or that the market will move. You don't care if it goes up or down in that sense, right? But you just think that the market will move. And that's obviously a good concept if you don't know about direction, right? So for example, I think the 100K mark that we actually just broke downwards was a good level to maybe buy a straddle, right? Because are we going to range around the 100K that much? I don't know. I mean, we have been already. I thought, either we're going to like bounce back from here and continue the bull market, or we're going to break below the 100. For a lot of people, that's maybe the sign bull market is over, and there's maybe a lot of stops below 100. So we might just go much lower, right? So at 100K, it was maybe a good idea to actually buy a straddle. And then you basically see on the right, that's how your payoff graph looks if you long or short a straddle, because obviously you can long a straddle by buying the call and buying the put. Then you long volatility, or you can also short it, right? So that means you're shorting a call and you're shorting a put. And that means you're taking the view that we are just going to keep in that range, right? Maybe, actually, I kind of want to jump a little bit slides to overlaying. Maybe you can go like 3 slides to the front, Dan, quickly. Yeah, so this one. So this one was actually, I think, like 5 days ago or something. So it's a good.
Can I jump in with a question on straddling?
Obviously. Sure.
Yeah. So you're saying that it's only good for volatility, which means it's like short-term moves. It's not something you want to hold long-term?
Well, it depends, right? But so maybe that is also a good bridge again to the perpetual options. So the perpetual options I mentioned, they don't expire, right? So that means, well, how does that translate to a proper option, right? Well, like I said, that you pay funding, and the value of that option is basically as if it would be an option that expires in 5 days. So that's kind of the time frame. And obviously 5 days is pretty short, because there's options that, are 3 months out, 6 months out, a year out, right? So 5 days is a pretty short-term time horizon. So I think you're right in the sense that this is kind of like a short-term trade. However, that also means that, for example, if you think we're going to chop in that range and I'm going to sell the straddle, that this P&L graph that we showed is the P&L you make every 5 days, basically, or like over 5 days. But if you think it's going to be like that for the next 15 days, then it's actually 3 times that profit, right? Because you will constantly receive the funding since you're short these options. But yeah, for straddle, the thing is, as soon as you're right with the straddle, you actually have a lot of directional risk suddenly, right? Because you have a put and you have a call, and if you move in either direction, either your put or your call will be quite far in the money, right? And the delta will pretty quickly move close to 1. And the other option that you have will be almost, kind of dead. It's like almost have a 0 delta, So suddenly you actually have a very directional position. And you can then there's multiple ways to actually manage the position. You can either start delta hedging it with the perpetual again. We can do that live later actually on the platform. I can show you how you can, set up a delta hedge trade or manage it over time. Or you could actually kind of build another combination by adding different options again to the mix, right? So for example, you have now a call option that's deep in the money, and now you can maybe actually sell an at the money call and basically make a call spread out of it. And you can maybe sell that put that's kind of dead, And then suddenly you have a call spread combination. So you can kind of transform, once your view turned out, you can also transform it into the next kind of combination to again express what is your view now, right? Or you can just simply, sell that option and then basically close that structure down.
I have like a 20% understanding of this, but I'm glad we're going to walk through these steps. How about you guys? Steamboat, AK.
Well, I do trade options quite a little bit, so I do understand what Fred is talking a little about.
How much? What's the percentage?
I would say close to about 90%
Wow.
because it's
Okay.
such call spreads.
Yeah.
Yeah, I do trade such call spreads as well, and I see some of our Kryptonite Academy community members are doing such strategies as well on this part. So I have experienced this before.
For me,
Nice.
it's 50%. I know what straddles are. I know what call spreads are. I just never knew like the sequence of like when to do what. I've
Right.
always been running them in silos.
Yeah, but I'm glad I'm learning and when to use these things. So let us know in the chat if there's anything you want us to expand upon while we have Fred here to explain it.
Yeah. So maybe if you want to put that slide back on, then we can also kind of, because I think a lot of you guys, you probably trade with technical analysis. I know that's pretty kind of famous in crypto, and I'm not saying I'm not a big fan of it, I must be saying, but of course there's like certain nuances to it, right? And I think this is actually a good example. This was like, I think from 5 days ago when I kind of created, some of these slides or screenshot here. And what you can do, or there's like certain information you can also read out of the option chain. So for example, when I just talked about the straddle, right? Like buying a put, buying a call. So if the market, you see basically right now on the slide, we were trading at around 104K. If you buy a straddle, so you buy the 104K call and you buy the 104K put, it costs you maybe something like $3,800 combined, and that kind of shows you the market is pricing in a $3,800 move up or down in the next 5 days, because 5 days is the time horizon of those options, right? So now you can basically put maybe as a TA, do like your range in there, right? Like what's the lower part of the range? What's the upper part of the range? And for example, I think that straddle was even cheaper than the lower range and the upper range part, right? So if I now sit there and think, what? I actually don't even think we're going to continue ranging. I think we're going to break out of those ranges, either to the upside or to the downside, right? Then, of course, you could think about maybe setting some stop market orders there with perpetuals or something, or you could buy the straddle, right? And if the straddle is actually cheaper than your breakout levels there, then maybe it's a good trade for me, for my view that I have, right? But overall, it kind of just shows you what is the market pricing in over the next 5 days in terms of move, and you can basically overlay these prices, so the lower end and the upper end of the straddle price with the upper and lower range of, you think where the price either keeps on ranging or breaks out. So in this sense, even if you think we're going to go, to the upper range and to the lower range, maybe even selling the straddle wouldn't have been the best part here, because the straddle was relatively cheap. It was cheaper than even touching the upper or lower bound of the range. Maybe there would have been other combinations. Maybe like you could also, a strangle is very similar to a straddle, but you actually buy a little bit, or you sell a little bit of a lower strike put and sell a bit of a higher strike call. So you have kind of like a bit of a buffer zone in the middle.
Did you say it's called a strangle?
It's called a strangle, yes.
That's the technical term?
Yes.
Okay, just wanted to confirm.
Yes. It's that's why it's very close to a straddle.
Yeah, okay. I mean, the letters are close, but it's a very different action.
Yeah. True. So this is kind of like where I would encourage people to like kind of calculate what are these prices of like a straddle, and like overlay this on the chart as well next to your technical analysis, basically, because that gives you an idea of, is what I expect the market to do, is that actually cheap compared to the options or too expensive maybe, right? So you can kind of combine that.
Sorry, Freddie. Are we able to demonstrate that on our
You mean just kind of doing a bit of a technical analysis and looking at the straddle price at the same time? Yeah, we could. I mean, just shoot over maybe to my live sharing of the Paradex page, Paradex UI, and then we can do that right now. Maybe you know. So
Yeah,
whenever
jumping over to your screen.
Sure, sure. Okay, so we're right now. Let's kind of use ETH, right? I'm not a technical expert, to be honest, analysis expert, but we basically just dipped onto that low right here, right, from November. I don't know, maybe AK, you can help me here. What's a good range? Is it maybe also the 10th low? Is that where you would put a line, for example, like here?
Yeah, we're seeing somewhere like the market is a little bit weak right now. So somewhere here around 3.4 to around, I mean, we just touched below 3 this afternoon in Singapore time. So I think somewhere around 2.8 might be the next range between 3.4 to 2.8.
Sure. Yeah, that also, I guess, aligns a bit here with previous previous lows and highs. Okay, so we could now see actually what would also be nice, I think, in that sense. Let's imagine you kind of expect a bit of a rebound, right? Like we just broke that low. Maybe we just thought it was kind of like a little scam wick, and we're at least going to touch that range here of 3,400, the upper part again, right? So what would be nice to trade is probably a call spread here, right? So you could say maybe I want to buy a call right now here at like 3,000, 3,100, and I want to short a 3,400 call because I don't think we're going to go below that range. So how you would do that is you just basically go to the option chain, and you can basically look at, let's say we are buying the 3,100 call, right? So that would be around $88. And we're going to sell the 3,400 call, which nets you again $22. So overall, you're going to pay around like $64, right? Because you're selling this call, so you kind of need to collect that, and you're paying this. So it's like $66, right? So if we're going back to the ETH future, we would basically pay right now $66. And then I'm going to put another line. So we're at 3,050. So at 3,110, this would kind of be our break-even point already. And everything above here is like kind of max profit. Like here is max profit at 3,400, right? So if you believe, we're definitely going to go back into this range here, then, but we're not gonna go above 3,400. That might be actually a good trade to do. We can also, let me just remove that. We can also go to the example that we just talked about, right? The straddle. So 3,050, we would basically buy the call for 110, and we would buy the put for 100. So that's in total like $210, right? Both combined. So if we're now looking at $210, the upper range is $350 above, and the lower part is like 210 actually. So that's kind of like the same price as the straddle. But let me put another line in here. So 210 above is 260, right? So the straddle price is basically for the next 5 days. The market is. Can I actually put nice arrows in here? You see, I don't usually do that often. Can't find the arrows, but you can basically see the market is pricing either a move up here or a move down here, right? So wait, sorry, now I know which one I need to use. just can do this one, right? So it's pricing either a move to here or a move to here. That's the range that the market is pricing over the next 5 days, basically. And if you believe in the next 5 days we are going way above that or way below that, then buying the straddle should be a good strategy. If you believe that this is indeed the max and we're just gonna chop around here for longer, then you might want to sell it. But yeah, that's, like I said, I think the straddle is actually a nice thing to overlay on your chart, the upper and lower range of the straddle, to kind of get a feeling of what the options market is pricing in terms of moves.
Got it, Freddie. So in this case, I'm buying a straddle. I am buying the call, and I'm buying the put at that same ETH value, ETH price.
Yeah. So then you make money. So we are now at 18th November. Like I said, they usually have, they act like they're 5 days to expiry. So on the 23rd of November, can I use another horizontal line, vertical line? Yes. So on that day, you should be above that level or below that level to make money with it.
Got it. And because essentially these are two different directions, right? So when the price moves, one of these positions will be in the red, one will be in the green. So how do I make money? It almost feels like it would be evened out.
Well, it will be evened out if you're exactly at that level here, at those levels. Then it should be evened out. And if you go below or above, if you go above, your call P&L will be higher than the loss from your put. If you go below, your put P&L will be higher than the loss from your call. Because we just talked about it, right? Like delta changes. So the lower we go, the put will pick up more delta. So it will be closer to 1 delta, and the call will lose delta. But you still have one option each, right? So one picks up more P&L than the other.
Got it.
So if we go back to the strike grid, you see, for example, here with the call, right? The one that is deep in the money almost has like a delta of 1, right? It's 0.94. And the ones that are far away, the delta is kind of like getting much, much lower.
Got it.
But since we're already on the screen sharing, I don't know, is there any like question actually in between, or otherwise just let me know.
Let's check the chat. If there isn't a question, if there are no questions on the chat, I'm going to ask questions.
X went down for a little bit. It's still.
Oh, is it still down?
Shaking. Yeah.
X is going up and down. On and off. So, so Fred, what I always fail to understand is in that kind of strategy, I don't know when to close any of the positions. Like if I keep it running, I don't technically make money. At some point, I lose, right? Because I'm buying both directions. If the price goes up, at some point, this is gonna, I don't know. I'm gonna get. It keeps feeling to me like it's always going to be balanced, but I know that's wrong. So at some point, I need to know when I need to either close the position or set some kind of limit, or when do I do those?
So that really depends. Like either you basically have a strategy already before where you say, the straddle will, in the next 5 days, I think we're just going to go up to not only 3,400 but 3,600, and then at 3,600. Obviously, you can just like close down the whole strategy, right? You can just sell the put and sell the call. You can also say, let me sell the call because I think there's no upside left, but I think we could range lower again. So maybe you want to keep the put, You can also say that now I think we're starting to chop, and we're kind of like not moving either up or down anymore. We're kind of like hanging around here. Then you can, like I said, maybe make a call spread out of it, and you can sell the 3,400 call, and that will actually gets you more in funding than what you pay for that deep in the money call. If you still want to, if you still want to say we're kind of pinned down here, Or you could also start getting the perpetual into the game, right? So maybe actually let's kind of do that.
Freddie, one last point. I'm just
Sure.
going to close off my understanding, and hopefully that kind of syncs with other people's attempt to understand this as well. So focusing on purely just a straddle. So because I believe that the price will be within this range, is it possible for me to say like, okay, I'm going to be disciplined. Whether the put or the call goes beyond the range, I will just close the whole straddle strategy, and then I will just reevaluate everything all over again, because that way it saves someone who's inexperienced the potential risk of making a mistake down the road.
No, absolutely. I think, to be honest, it's a good point, because you one thing, and I think a lot of people will probably agree, is like over trading, right? You think like you're catching every wave, right? You were right with this big move up now, so now no, we're gonna go down again, or we're gonna go further, and so it's absolutely a good way to just like close it off, right? And reevaluate, think, okay, fresh look at the market right now, do your technical analysis, put the new ranges in, like, what are we gonna do, right? And then assess from that moment on, okay, based on my view, what the market will do now, what's the best trade again to do, right? Because like I said, after, you bought the straddle and you were right with it, because there's like a huge move happened, right? You could also say, okay, that was the kind of volatility that just expressed that I was betting on. But now the straddle is actually quite expensive. You can put the ranges again, because maybe volatility went up based on that sharp move. And now I'm actually I want to be short volatility instead of long, right? And then it's, of course, a different trade, right? Because then you could either short the straddle, you can do certain like call put spreads that kind of express a short view as well, or you could just sell an option and hedge it with the perpetual. I actually think maybe before we kind of continue with the different option combinations, maybe we should actually just walk through how to put up a one option leg and hedge it with the perpetual, because that way you can also express a long volatility or short volatility view with this. So what I, for example, like to do, a very, very straightforward trade, is actually kind of longing volatility still. But for example, I buy 0.5 ETH right now, as a perpetual, basically. And I want to, and I kind of like hedge myself off by buying a put. So I can use the at the money put, right, which has roughly the same delta. So let's just kind of buy that one. So I'll buy one of those. And now, for anyone following along what delta is, there's a risk tab here, and you can actually see that the delta from our perpetual, right, is 0.5, because that's a linear contract. The delta doesn't change here. But the at the money put has roughly, almost minus 0.5. So basically, we just started this position in a kind of delta neutral way, right? So if the market moves like up or down $1 right now, I'm not gaining or losing anything, right? It's basically just offsetting each other. There's basically there's very little risk right now. But what we're essentially betting on is long volatility again. So a sharp move up or a sharp move down. Because imagine we're going now $100 up. And let's say we do that, very, very quickly. We can actually already look at the option chain and see if that put, because that put would be $100 out of the money, right? Or let's say maybe $50, because it's a bit, we don't have a clean strike here. But you see the delta would go lower, right? The more we go up. Because these are the puts that are out of the money. And that one will become out the money the further we go up, right? So the put is losing its delta. But since we are long the perpetual is linear. So it's always 0.5. So if we go up, I will start making more money with my perpetual position than my put will lose. And it's the same way down, right? If we go down a lot, that put will pick up more delta because it's dynamic. You actually see it, right? It's not a big move, but we just went down a little bit, and the put actually now collected a little bit more delta already. So now we have a little short exposure already. We make like, I don't know, what is that, 0.3 of a cent every dollar we go down, right? But this will pick up more and more, because if the put goes deep in the money, it's almost like 1. And we are still only 0.5 long with the perpetual. So what that in practice means is if we go down a lot or we go up a lot, we make money. But initially, it's a very low risk trade right now.
Got it.
And that's not really an option combination. That's just like buying one leg, and you can hedge it with the perp, and you can still express a long volatility or short volatility view like this. Of course, the short volatility view would be if we do this the other way around. Actually, because during our workshop, maybe the price will move. Let's just do like a little transfer to my other sub account so we can just show off the kind of other side of it, right? Like we want to short volatility instead of long.
Freddie, while the transfer is happening, I'm just going to ask a question. So my misconception, and I think this might apply to at least a few more people, is that a delta neutral strategy is balanced all the way, but because the delta shifts as the price goes up or down, technically a delta neutral strategy is only neutral at the start, the moment it is created. But
correct,
you earn either direction, so technically it is a profitable strategy. It is not just farming like funding fees, for example. It's
yeah. Okay. No, like it's exactly what you said. It's like it's delta neutral when you enter it, right? And that's, to be honest, that's the beauty about options, that your position always changes. That's the great thing about options. That's why these Greeks, they are like derivatives of it, right? Because they are kind of always deriving from the underlying value. And if the underlying value changes, or some of these other parameters like Vega, like volatility overall, then your position changes of your option. And if you do that in combination with a perpetual, it's the same thing. The position will eventually change, and you kind of either collect risk on the long side or short side. But yeah, so what we just did was like a long volatility view, right? We can also do the exact same thing, basically, but betting on short volatility. And what that effectively means is we're kind of betting that the market will not move, or it will certainly move less than what is the implied volatility. To be honest, with 80% right now, 82% volatility it's quite high, because obviously we have been dumping, so there's a bit more fear, there's a bit more expected move in the underlying, so volatility went up. So maybe I could say, what, I kind of want to short volatility right now, because I think that's the better way right now, that we had the big move, and we're not gonna
got it. Freddie, show us what number you were referring to when you mentioned volatility.
It's basically this little thing here. We actually have a slide. I mean, if you want to quickly move, it's kind of like from Deribit. Yeah, exactly, this one. No, the IV rank, this one. Yeah. So there's like kind of like, to keep it simple, there's like an IV rank or percentile, and that just basically is almost like a map to show you how expensive are options currently compared to like the last 12 months, for example, right? So this is like from a couple of days ago, and it's actually for Bitcoin, so it's not super comparable, but we probably most likely went up further since we dumped. But it basically shows you, okay, Bitcoin over the last 12 months was trading between, like 25 and 80 vol, something in between. Those were the min and the max. And then you see the IV rank right now is like at basically 30. That's kind of like what the current IV is priced at. And then the IV percentile is more on like how frequently that underlying has been trading in this volatility range. So it's more about like how many days has it been trading below or above the current, volatility. So for example, if you look at the right, the IV percentile basically says that 60% of the time over the last 12 months, the volatility was higher than it is right now, But then on the IV rank, you see that actually it's still kind of only at 30% of the max IV it ever traded over the last 12 months. So tiny difference, but it's basically just giving you a little bit of a map, a bit of a gut feeling about relatively over the last 12 months, is volatility currently cheap or expensive? And ultimately, that also means are options right now cheap or expensive? Of course, cheap and expensive is a kind of difficult term to say, because if you, for example, say, there's like, there's, FOMC interest rate decisions, like very important economic data, the economy has run hot, like I expect like there could be a huge move, then you could still think that they are cheap, even though over the last 12 months, they're like relatively expensive already, but it just gives you like I always say it's similar to like TradFi in doing some sort of like fundamental analysis of a company, like knowing what their fundamentals are, their revenues, etc. It doesn't necessarily give you an idea if the stock goes up or down, but it gives you like a live vest, to understand, okay, is the market pricing in a lot more expectation or a lot lower expectation to how it currently is?
Freddie, I'm just gonna try and summarize this for myself as well, based on what you've just taught us about Straddle. So, for example, in the screenshot in that example, where the IV rank was about 30 for Bitcoin, would then be an opportunity for me to create like a long straddle strategy. So then inversely, which is what you're explaining now and you're going to be showing us, is that in this current time where the IV rank is high, that's when it's an opportunity to do the short straddle, because we expect the volatility to kind of roll back down.
Yeah, I mean, to be honest, like overall, that's not a wrong thought, right? To kind of keep it simple, you could say, IV is pretty expensive right now, so let me just like sell IV, right? I think it might be a better way would be to do the kind of hedged thing with the perpetual, because still, the thing is with options, the IV can be high and you can sell the straddle, but you can still be very wrong on direction, right? It can still just grind up or grind down very slowly, and you kind of lose money on that, even though IV is also compressing and coming down. So the only way to kind of really monetize on volatility coming down again and you selling it high would be to kind of dynamically hedge it, which is basically the same thing we just did. We hedged the option, but we keep on hedging once the price moves, right? So for example, if you just want to share my screen again, I think I can just kind of show that a bit live. So actually, we just talked about like doing the kind of short vol trade, right? So we just sold the call and we're buying the put, and our delta is again flat. But now you can see it already. That's the perpetual option. I told you the premium is kind of exchanged as a funding rate. So that's why we are now getting every 8 hours, we get like $7. If the market doesn't move, that's perfect for us, right? We're just collecting $7 every 8 hours, and we're basically delta neutral. That's being short volatility, right? So you don't want the price to move. But moving back to, for example, the long volatility part, we want the price to move, otherwise we pay this funding or we pay for the option premium, right? But so dynamic hedging, right? So when you're long volatility, it's basically, I also would say for any beginner, if you're trying to play around with option, it's generally safer to buy options and hedge them, because there's significantly less risk involved, right? Especially if you have like a job, and you're like 8 hours not on the screen, and you just like in the evening check in, because imagine right now you're 8 hours not there and the market pumps up or dumps down. When you open your screen, you're actually like, hell yeah, right? Like I made money because I was long volatility, but if you're short, you actually lose money, because if the market goes up, you actually accruing risk in the other direction more and more. So if you're long volatility, what you want to do is the simple principle of sell high and buy low, basically. Because if the market now goes up, my perpetual has still 0.5 delta. My put will have maybe minus 0.3 only. And if you then want to make it delta neutral again, which is then kind of the process of dynamically hedging it, you would sell 0.2 of your perpetual off, right? So that you're delta neutral again. And that effectively takes a little bit profit, right? So that's why kind of sell high, buy low makes you actually taking profit each time. And if you're short volatility, it's the exact way around. You're kind of chasing the price because let me actually go to the other sub account here, right? So if we're now going up, I'm only 0.5 long, but because I'm short a call, that one will be minus 0.7, for example. And the higher it goes, the more I am short, right? It might go from 0.7 to 0.8 to 0.9, but I'm still only 0.5 long. That's my hedge leg. So every time it goes up, I kind of like need to buy more. And if it goes up more even, I need to buy again more to stay delta neutral. So that's kind of like why I'm really trying to put the simple notion of you need to chase the price. You need to, if it goes up, you need to buy into the up move to manage your risk.
Understand.
So that's why it's a little bit, it's a bit more difficult. So like I said, if you're a beginner to option and you're not constantly on the screen, that can actually be very dangerous, right? Because if you're short vol and it just pumps up or it goes down, you actually lose a lot of money and you come back and, open the screen. It's like, shit, I just, lost a lot of money. And yeah, like the other way, if you're long vol and it happened, then it's good for you actually, because then you can say, oh, let me now hedge again, right? But that means you're actually taking profit.
Got it.
Now, we had a couple comments. Menno, can I hire Fred as my asset manager?
I don't think you want to.
Maybe a vault. That's probably the easiest way to do it.
But did you not hear what Nick said about the vault?
Oh, but Nick also said he took profit, so Nick is in the green. I would imagine.
I hope so.
In the crypto channel,
it is very. I mean, I think everybody knows it. Trading is also very, very psychologically thing. I can like very, let's say, sanely talk about these topics right now. That doesn't mean that I'm also doing this right all the time. We all get sometimes drawn into, I think it's going to recover. I'm not going to hedge it right now. I'm going to get greedy a bit, and all these kind of things. I'm just a human too. That's why I say I don't think you want to hire me as an asset manager.
In the crypto channel, can look if BB contract before expansion before using Straddle. I don't know what that means.
Yeah.
Can look if
B contract.
Yeah, I'm also not too sure.
I know who asked this, but I think we can skip this one now if we are.
Okay.
Well, feel free to elaborate a bit again, then we can come back to it.
Okay, well, that's all we got for now, and we can keep moving on.
I'm so sorry, Freddie. I'm going to ask one last question, okay, before we
Don't be sorry. That's the purpose of it.
I'm struggling to understand why being long on volatility is safer. Sorry,
I mean, it's safer. I would say it's safer if you're like a beginner, right? Because there's like less to lose, right? You can maybe kind of lose the premium if it's like a dated option, or on Paradex with the Perpetual, it's like you can lose a little bit of the value of the option and a little bit in funding. And it's also, if you go like for the big firms that really trade options, there's kind of like two strategies. You can be generally long volatility. So for example, I think Nassim Taleb, he was like talking about this like black swan events, right? That they are kind of like underestimated. So I think he had like, or maybe not him, or there's like inspired funds from him, like black swan funds that basically buy like very far out the money put options, right? So overall, on a monthly basis, that fund maybe was burning through like 1 or 2% of the capital, right? So on a yearly basis, maybe lost like 20%. But then once the black swan happened, like it made like, I don't know, 100% return, right? So being long volatility is usually wrong because there's like a risk premium that you pay for being long. But if you're right, then it can pay off quite well, because there's also the term of convexity, which kind of means it's a non-linear payoff, not like the perpetual. If, the market goes up, you have a perpetual, like your profit go like this, right? With an option, there's like a curve to it, right? Like there's like convexity, you call it. It's like non-linear, So most of the time, you're kind of wrong being long volatility. You pay the risk premium. But the few times when you time it right and you can be right with it, you can, gain a lot more. If you're short volatility, there's a lot of funds that are short volatility all the time, that maybe yield like 2% per month. It's kind of more of a constant stream of profits, But if you get caught up on a big move and you're kind of bad hedging it, you can actually like lose a lot, So it's kind of the other way. With the long volatility, you're most of the time wrong. But if you're right, it pays well. If you're short volatility, you're most of the time right. But if you're wrong, you can lose a lot.
Got it. And I want to bring up one more point just to summarize for everyone. It feels like delta neutral is so misunderstood. And the way Freddie explained it is so much clearer how you utilize that strategy. It is delta neutral at the start, and how you maintain that strategy is you bring it back to delta neutral. So then you basically, that's how you keep riding that delta neutral strategy. It's not like delta neutral now and then you leave it. You keep bring it.
No, exactly. You can, and there's like different ways you can do that, right? So there's I would say the two most obvious ones are either once you pass a delta threshold, and two is, and I think both are actually viable. Two is like a time-based hedge, right? So you could either say the market moved a lot, and now I accrued 0.1 delta in either direction, so I'm going to bring it back to 0. And if that happens again to 0.1, I bring it back to 0. So it's like a threshold based, right? You can also say, and that maybe adds a little bit of randomness, but in trade, I don't think that's necessarily wrong. You can also just say 2 times per day, for the guys at work, maybe 1 time before work, 1 time after work, I'm just making it delta neutral again. Like whatever happened in between. Maybe market didn't move and maybe I don't need to do a trade, but maybe it actually went haywire and I have like 0.4 delta in the evening, put it back to neutral,
Okay, tomorrow I'll try that.
But the thing is, you should be kind of consistent with this,
Okay.
That's the difficult part about it as well, though.
We got a few comments. Sticky GG Steamboat, you're asking great questions. No need to be sorry.
Correct.
Those are great questions. We got a comment from Roman.Dime. Is it possible that someday the funding and commissions for options trading will become closer to those of futures trading? Because at the moment, the main problem with trading is that you have to pay a lot, which makes it impossible to short option trades with small spreads.
Well, I mean, there's a couple of questions in there, right? So First thing is, will the funding of the options be closer to futures funding? So for the perpetual options, I can basically say no, because the key about the perpetual options is that the premium that you usually pay in dated options is expressed as the funding. Obviously, sure, if volatility comes down a lot, then that means you pay less premium and the funding will be lower. But it will not be close to the futures funding, because then that defeats the purpose of the perpetual options, and nobody would sell them to you anymore, because it's kind of like it would be a no-brainer to just long them because you barely pay any funding, right? So that's kind of like a different thing. But I guess the commission, that's a fair point. Could be. I mean, the spreads are obviously a little bit higher on options. That's to be honest, it's a universal thing. I mean, you will always see that on all kind of option markets, even in TradFi. The spreads are always a little bit higher, and that is because market makers take a lot of risk quoting these, to be honest. It's not that easy for them to manage a complex book of all kinds of options, long, short, puts and calls, because the job of a market maker is always to manage risk, right? They don't want to be exposed in either direction. For them, it's really kind of about collecting the bid and ask spread. That's the only thing that they, in theory, can earn, right? So, yeah, I would say probably to both of your questions, it's difficult. Like the first one with the funding rate, that depends just on the volatility, you know. And right now we dumped a lot. We just looked at ETH at 80%. It's relatively high again, you know. So you pay more for it. Although what I would bring in, and that is a very important aspect, because we're just talking right now about this whole dynamic hedging, right? And delta hedging, and doing this over and over again. In principle, there's a lot of cost involved to it, right? But that's actually where Paradex is pretty great, because some of you, I would hopefully know, all of you know, we have, of course, this RPI orders for retail traders, right? And 0 fees. So basically, your hedging is free. You don't have any commissions, and you barely pay anything on the spreads. So even if you're short options, where I say, you know, you kind of need to chase the price, and you need to do a lot of frequent trading. Like, a lot of people automate this, obviously. But, you know, if you need to do a lot of frequent chasing of the price, and you need to kind of keep buying if it goes up, you can do that basically for free. And that is actually a huge thing, because if you're short options, and you kind of need to do a lot of small frequent transaction, there's a lot of commissions, you know. On TradFi, sometimes you pay like $1, $2 per trade, doesn't matter what size, right? So that can actually add up significantly. So the hedging on Paradex is basically free. So that makes it kind of interesting in that sense.
Thanks for the clip. Good, that's going to be a great clip.
Yeah, should we maybe quickly, because the market is moving a bit, so now we can actually kind of see what's happening with the delta neutral trades we put on, right?
Okay, can you guys, I gave you guys access to control the scenes. Can someone try switching it over?
Well, if I would know how to.
Oh, you just click Alt-4 Showcase. All good. Okay, here we go.
Yeah, then that's your job, man. Just
I got it.
keep doing it. Okay, so let's say the one where long volatility is probably more interesting, because here we would expect, you see, the put actually picked up a little bit more delta. So overall, we're a little bit short right now. If we look at our positions, we're probably still not overall in profit, because obviously we crossed the spread for the put, right? And we also paid a little bit in funding already, which we see here, 33 cents, and we crossed a little bit the spread. So the entry is, you know, you have a little bit to catch up, basically. But you see that, that basically the put is picking up more delta right now. So we're getting short. The more the market now dumps, the more short delta we actually pick up. And that means we're actually starting to make money right now if the market goes down, right? It's only, of course, 1.5 cents, 1.8 cents per dollar. But of course, that depends, you know, on your overall position sizes, etc. But you basically see that the put is picking up P&L, and the perp is kind of picking up negative P&L. If we still keep dumping more, maybe we will do it during our call, you should basically see this one flip, so that the positive P&L will be bigger than the negative P&L here. That should happen once we go down. And if we now look at our short one, you also see we actually picking up long delta right now the more we go down, which is kind of risky for us, right? Because we're actually starting to lose more money. So what we would do in both situations, I mean, let's imagine this is a bit of a bigger move, right? But to make this delta neutral again, we would basically just sell off some part of our perp. So let's say 0.02 or something, right? I hope that's below or above the minimum order size. Yes, it is. So now we're almost closer to zero again, right? And on our long volatility, we would kind of do the same thing, actually, right? And that we can also just now see in the trade history So here in the trade history, that should. Wait, did I do the right thing here? Oh no, sorry, I did the wrong thing. we should have bought.
Oh,
Yeah.
Let's buy. But basically, you see, once you buy, you're kind of like realizing P&L here. No, sorry, you're not realizing P&L. That's when you.
No, you return back to delta neutral.
Yeah, I return back to delta neutral right now. Yeah.
But I think because the sell was took a loss in a way, or additional loss, so there is a
That was a mess up on my part. Sorry, I switched too quickly around.
Yeah, this is the correct.
So both ways have been delta neutralized, right? So here we took a position off, and on the other we actually added to the position to make it delta neutral. But it really depends, because here it's just we shorted a call and we longed. We could have also done shorting a put and shorting the perp, which is actually also an interesting. Let me actually do something here. I can do another sub account. So also a nice thing, right? On Paradex, you can just one click, oops, another sub account, and you just transfer some funds there. And you can run. Oh, am I too quick? Probably. You can basically just run different strategies, right? So like one sub account can be your long vol strategy, one can be your short vol strategy, and it also, that's also maybe a misconception. You can still make money on both strategies, right? It just really depends how well you are with your delta hedging, right? And maybe also a kind of randomness factor you put in, if it's like a time-based hedge, and maybe the short one is not a time-based but a threshold-based. So you can still make money actually with both strategies at the same time. So yeah, let's do the. I actually like the shorting a put. So we're selling the put. Need to cross the spread here quite a bit. And then just to kind of double check what we need to do. Oh, so that's actually also a good point. So by default, this delta is all expressed in dollar. If you want to be like me, I really prefer to have this all like notional. You click on the top right here on the settings, and you go to Greeks, and you show the Greeks as a position instead of cash. Because now you actually see it in like kind of, in a position term,
so you gotta sell 0.5 ETH perp to balance this out.
You got it, man. You got it.
All right, learning.
0.517, right? That's roughly it. So now we're delta neutral again. And now the funny part is we actually also collect funding, on the future. And we collect funding from the option. So it's not. I'm not going to say like this is some sort of hack, because it's kind of expressed in the option price, and but it's a nice little gimmick in that sense. So yeah, you see, because we needed to cross the spread here. We're like kind of down, $3 already immediately. So that's something you need to kind of first make up for. But yeah, you can sell the perp, sell a put. Now you're short volatility again. And just keep on managing your risk and do dynamic hedging when the market moves. But yeah, like I said, I would for every beginner, I would definitely recommend start with being long options. The thing is, the funny thing is, so if you're really bullish on something as well. Like, you don't need to buy calls. That's also like a big misconception. Actually, in TradFi, that's one of my favorite trades I usually do, is I actually buy like a shit ton of the stock, and just buy a put, basically. So just to kind of make sure I'm hedged if I'm really wrong, but it still overall makes me very bullish on the underlying, because if we move up, like my spot position in stocks make a lot more money than the put that I paid a premium for. So there's like a misconception that you can use puts to hedge your long position. And then the next thing is also to, like, the put is kind of like, you could see this as a it also gives you ammunition once you're kind of wrong, right? And the market dumps and your put accrues a lot of P&L, like positive P&L. You can also use that capital that it provides to you to actually increase your position at that level below, right? So it actually has it has some utility beyond just like a technical stop loss, right? And you could also see it even as a rechargeable stop loss. So maybe to give one like comparison to perps trading only, because I think a lot of people trade perps with high leverage, stop losses, right? We just talked a lot about like being long volatility or short volatility. Every time you do this, you trade the perpetual and you put a stop loss, you're actually short volatility, because your view is basically that we're only going up from here. We're not having a big range down and then up or something. But the problem is in crypto, at least I would say, like the majority of times, you kind of want to be long vol, or you don't want to be short volatility, because once things happen, like you just get wigged out and then, it goes up. But you basically always short volatility when you put a stop loss. And the problem is also, once your stop loss is hit, like the loss is realized and you're not in anymore. If you have a put instead, it's like rechargeable, right? You can survive like a chop that it's like going 2 or 3 times and then it goes up, right? And with the perpetual options, even more so, because they don't expire. So it kind of is like a rechargeable stop loss until you sell it.
Damn. I mean, when you put it that way, it makes a lot of sense. But it always feels like for people who are not as savvy, like the stop loss is the only way to like save yourself, save your capital.
Yeah, I mean, look, I'm not talking like and saying that stop loss is bad, right? Like it's part of risk management, but
right, of course.
Consider that options are also part of risk management, or can be used as a risk management tool.
So, I like how you were sharing, like me buying like a spot position, or me buying like the asset. I could use like perps or options as a hedge. So then if I could, for example, in the future on Paradex, like also buy spot, I could, like, I guess, be able to create like a delta neutral strategy. Like I would buy like 1 ETH and then I would maybe like I don't know,
Buy a put.
sell the perp.
Oh, you can, yeah. Wait. Sorry. What do you want to do?
I want to hedge my spot position.
Yeah. So you kind of have a spot position. You're long, and you want to kind of you want to hedge yourself by buying a put, for
Or buying
example.
a put. Okay, got it. Yeah, because
Yeah,
buying a put is...
Yeah,
All
so
right.
that's like a long volatility view. You could also kind of hedge yourself by selling a call, but then again, then you kind of give up on a lot of upside potentially, or it's just a different view,
Got it.
But again, the beauty about options is that you can just be much more precise about what's your view on the market. You don't just need to be have a stop loss, and once there's like a wick, you're out, and your view still overall turns out, but you're not in anymore, right? So like it gives you more flexibility, and like we also talked about earlier with the straddle, right? Like you can basically overlay that with your TA and say we're staying in this range, we're just gonna chop around here. So the straddle is actually right now, maybe the straddle break evens would be above your range. Then it would be good, because then you can still say, I'm just going to sell that straddle once we break out from my TA levels. And you're still not losing money, basically, right? But then if you're right and you're just chopping around within your range, the straddle, you make a lot of money, or you make a bit of money by selling the straddle, basically.
Gotcha. Man, when we were working on like the slides, we kind of figured we could cover a lot more, but it seems like just the idea of straddle, delta, neutral, like that was a lot to cover and to unpack, and I think that's probably, I think for now maybe that's just nice for the audience, and based on the time, and people seeing the examples, hearing all the different things, they would probably need like some revision to watch this video, like little clips 3-4 times again before they're like, okay, I know what to do now. So I'm gonna say this. I think maybe we can close off for tonight, and then we have more sessions in the future where we cover the other concepts. Because this can go on for 3 more hours if we wanted. I'm very
Or
sure.
even more.
Yeah.
Yeah.
What do you think, AK?
Yeah. I mean, definitely, it was such a great session with Freddie sharing all the, sharing the concepts of just a simple straddle in a way,
Yeah.
and that will actually help you to kind of like navigate whether is it I would say a bearish market right now, and you can actually try it out on Paradex to do a short or a simple small position. Okay, you don't need to go long, don't need to do a big one, just a small position. Try it out and see how it works in the next 3 to 5 days. And I know that you guys are watching this session itself, whether is it live or in recording, just put it in the chat. Say how do you enjoy it. If you have more questions, you can type it in there as well. Or if you like to learn more about all these options, you can also type in the chat and let Paradex team know about it so that they can continue this second session on this part as well.
This guy is good, man.
Exactly.
Oh,
Dan,
no, Dan, your mic is muted.
Okay, I'll read it out. From Roman.dime. What's up, Roman? One more slightly funny question. Why is it impossible to short options with a large volume? Is it related to the almost constantly green funding?
I'm not sure if I understand what you mean, because technically you can short as many options as you want. Obviously, there needs to be a market maker selling you those, right? Or buying those from you. And that might be the case once market makers, they run into some sort of position limits because they don't want to be too exposed one side. It becomes too costly or difficult for them to manage the risk. But generally, we talked about this earlier, right? Like, especially on Paradex, the perpetual options, obviously you get funding, you get the premium paid over time if you're short. You can do that, and you're most of the time probably right. But just be careful if the market makes huge moves and you get caught up in these options, because then the funding in itself that you collected, might not be offsetting the losses, of the position itself. So, but overall, look, there's no real limit on how many options you can sell, right? Just make sure you manage your risk.
Well said. Can you guys hear me?
Yeah.
Yep.
Okay. Awesome. So this was a great session. I think we'll be back another time and we'll dig in even deeper. Maybe some of us will take trades outside of Fred so we can actually get that hands-on experience. So if you're looking forward to more, be sure to follow. So closing statement, guys.
Options is a lot easier than people think. Okay, so just tune in for these sessions, and I think over time you will understand how to play the game, what kind of strategies you need during what kind of market conditions. I think that this is the most important thing. There is no one size fits all strategy. It is conditions, strategy, condition, strategy. There's always a way to play it.
Awesome. I'll go next. So generally, I always share this simple statement with my community in the sense of fire bullets before firing the cannonballs. So in this case, you guys have gone through the session with Freddie. It's just one strategy right now. So try it out with a small amount on the positions itself and get the experience running. It can be 2 days, 3 days, and then find out how is it like. Is it something that you like it? Is it something that works out for you? If it does, yeah, go ahead and fire the cannonball yourself. Do a bigger position in this case and see how it works out.
Well, definitely. I can only agree to what you said. I mean, overall, I think for me to kind of sum it up, I hope people understood that indeed options can be very complex, but they can also be simplified. And just see them as a as another tool in your trading toolbox, basically, and use them to manage your risk, or use them to express a very specific view that you have about the market, which are just much harder to express by just trading the perps. And then also, I think, understand that perp trading and option trading is actually pretty similar. I hope we kind of showed that a little bit with using technical analysis that most people use for perp trading, and you can kind of also do options trading based on that. And then, of course, also combine both, right? Like trade perpetuals, but also use options to specify your trading, basically,
Yeah, well said. So thank you for your time. Thanks for everyone for hanging out, and we'll be back soon. This has been a workshop by Paradex. That was the outro. I just kind of came up with it. All right, thanks, guys.
All
Bye.
good.
Thanks, guys.
Thank you so much for the invite. Take care, everyone. Good night.